Now let's get more on the outlook for commodities right now and bring in Mark Pervan, who's a senior commodity strategist at ANZ, and he joins us from our Melbourne studios this morning. A good Monday to you, Mark. Let's talk about oil, I guess, as that's in focus. What a seesaw event it's been in the last 2 weeks. I mean, we're seeing oil prices swing either way. Now it's $70 a barrel. What do you think is going to impact oil the most in the next few weeks?
Well, I think it's just a very timely reminder that markets go down as well as up. We've seen very strong gains, commodity markets generally, over the last 12 to 18 months. So the pullback or the volatility we've seen in the last 2 weeks is really partly a reflection of such, high gains over that period. So I think going forward, look, a lot of direction still coming from the equity markets. There's heightened volatility in the market, heightened risk aversion. Commodities by default are very risky. So unless we see that risk aversion start to abate, that volatility remains. I think we will see possibly some buying on the dip opportunities here, and that might create some upward momentum, but it's certainly going to be still a volatile story near term.
Hey, Mark, the last time we talked was in April sometime, and you were predicting oil prices to maybe hit $95 a barrel by the end of this year. Do you think you're going to throw that prediction out the window now?
Well, I'll certainly look. The view on oil is I'm going to have to pare it back a little bit. I think one of the things we've got to appreciate with oil is it is very much a proxy for global growth. And I think the thing the market may have underestimated is the impact that Greece/Europe is having now on global growth projections, as you earlier noted. So, and this is having a direct bearing on the oil market. So yes, we'll be paring back those expectations in the order of $5 to $10 a barrel. So maybe instead of 95 by the end of the year, maybe 85 by the end year.
Wow, 85 is still pretty bullish, don't you think, Mark, considering we're seeing a lot of doubt over global economic growth right now. You have the debt crisis taking place, and Europe and China might be a bit of a concern here.
Look, I think when you step back and look at the fundamentals, we're still in a recovery mode. And I think the market at the moment is being hit hard by short-term negative sentiment. Markets swing very quickly. That mood could turn positive at any moment if things in Europe start to cool. But I think in the near term, there will be increased volatility. But I can sense that with stimulus demand still being rolled out, interest rates still on a sort of a positive tack, I think we could see global growth conditions see higher prices going to the end of the year.
Okay. All right, let me talk to you about gold here, Mark, because it's interesting. Despite the volatility we saw last week, gold prices actually fell, capping the biggest weekly loss in 5 months. Now, with the gold prices at $11.80 and change, I mean, is this a buying opportunity considering the volatility we're seeing?
Gold market's a tough one. The rally we saw to record highs about a week and a half ago was based off a near already record high level of long positions in the US futures market. So they're now fully bought, and the reason we saw selling last week was really just that the market wanted to take profits off a very high level of sort of buying positions. So we're back to sort of a slightly more, I suppose, workable position. There was a build in the shorts last week. I think it's still going to be a tough road ahead going forward because the market has already priced in a lot of positive news into gold. But if we continue to see weakness coming out of equity markets, then we could see higher gold prices near term. Okay,
why don't you give me peak gold prices for this year, Mark? Are we looking at 1,200 and change, or even higher from there?
Look, I think 1,200 is not out of the question. I think the thing to watch closely will be physical demand, particularly in China. It's very strong at the moment. Heightened risk aversion. I think that's not going to. It's going to only abate slowly. So I think the gold prices are around these levels are here to stay. Could go a little higher if we see another round of concern in Europe.
Okay, how much higher? I mean, could we see upside over 1,300? I mean, give me a number here.
1,300's probably the top. I would say somewhere in the mid-1,200s, only because we're already at a full record long position on the US futures market, and that would require some pretty positive news to push it towards a 1,300 level.
Okay, now quickly, Mark, let me just ask you, what's a better buy right now? Some are looking at silver maybe because it's, I guess, underperformed the gains we've seen in gold, and there's just more value there. But if an investor asks you, what should I be putting my money into, what would you tell them?
Well, silver's a good call. I think it has the additional industrial demand backdrop. It's not as heavily bought as gold is. On a net long position, it's nowhere near record high levels. We're seeing very strong demand for solar power, for instance, at the moment, emanating out of China, but that demand's in Europe and here in Australia. So, silver powder, for instance, very strong at the moment. I could see that market outperforming gold near term. The other markets to watch is, maybe to buy on the dip in the bellwether markets like copper and oil.
Okay, Mark, thanks for talking to us on this Monday. Nice seeing you. Mark Pervan of ANZ Bank.